Hi everyone, my name's Darryl Panes, CEO at As Good as Gold Australia, and today, once again, I'm joined by my brother Brian and partner at As Good as Gold. And today we interview John Adams, Chief Economist at As Good as Gold Australia. How are you, John?
Good, sir. How are you going today?
Very well, John. You've been studying, mate.
Yes, yes. I had to put everything down for about 6 weeks and learn about Australia's federal tax system and sit a 3-hour exam. So
How'd
that
you
was
go?
fortunate. Well, we won't know for another 6 weeks. So they're going to keep me guessing, but the tax system is a mess and very complex. And I've been talking to people in Parliament saying you should do something to simplify the tax code.
So you've just been adding to your arsenal, basically. I didn't think you could do any more of that. You seem to have all of the degrees and everything already in place.
Well, okay, yeah. So I'm a big believer in sort of long time learning or lifelong learning, and there's a lot more stuff that I could be learning about. And obviously, when it comes to economics, the role of taxation is important, and so
Of
that's why I
course.
thought some time ago to go off and do a CPA, and the tax subject was the last one. And hopefully, if I pass, I'll not only be Australia's most controversial economist, I'll be Australia's most controversial accountant as well.
Good sense of humour to go with it, John. While you have been, good luck with that, of course, John. I know that you've been working really hard over the last month. While you have been doing that, I've just been watching this economy, as has Brian, and I tend to think, John, that all we've been doing while you've been studying is kicking this can just a little bit further down the road. And I don't think they can kick it much further. I think we're in a position at the moment where we're about to fall off the edge of the cliff. And this was sort of supported just recently. A couple of weeks ago, I attended a meeting and I sat and listened for 40 minutes to one of the major banks' leading economists. And he said, the globe or the global economy is in dire straits. And he listed a number of points to support that. And this is what he said. By the way, I'll suggest to you right now that I had a full scat page of notes at that point of time. That was at the 20-minute mark of the presentation. I knew the presentation was going to go for 40 minutes. I got to the halfway mark and I thought, I don't need to expand on this. I'll put my pen down because everything this man is telling me is what I would expect to get from John Adams. It's what I would say if I was talking to somebody else. And so we're on the same page. I felt really comfortable at that. So I put my pen down and here's what he had to say. He said, the world's economy is in dire straits. It's very difficult for any country at the moment to produce a good economy when the world is in, and in particular America, is in such a dire position. Let me highlight the following. He said, whether it be Donald Trump and this ongoing impeachment saga, keeping in mind that's trust. So there's an element of trust here. We're doubting, the world is doubting Donald Trump at the moment. If you're doubting Donald Trump, who may very well be the most powerful man in the world at the moment, then who do you trust? So he cited that as a really important point. Then he said, whether it be that, the complexity of the trade wars between the United States of America and, of course, China, no one wins in a trade war. And that's exactly what's been happening. And of course, this is just a continuing saga. There seems to be no end in sight. Or it could be negative interest rates on a global scale. It could be the ongoing Middle East crisis. And of course, we saw Turkey bomb Syria just recently. This is just going on and creating a very complex global environment at the moment. Or he said it could be QE4. Well, they don't want to call it QE4, but it is QE4. Or it could be Brexit. Brexit, of course, where you've got a country, a United Kingdom, wanting to regain its independence. So he said all of these issues are making governing and ruling and imposing good economic decisions in a country very difficult to make. So That was, and of course, business investment in the United States in particular is at a very low ebb. So keeping all of this in mind, John, I have a couple of questions, or one in particular I want to ask you right now. And that is that Australia's Treasurer, Josh Frydenberg, continues to claim that the fundamentals of the Australian economy are in a good sound state. But we constantly see more evidence that the economy is slowing down, including, the International Monetary Fund have now downgraded global and Australian economic growth. So what I would like to know is what your broad assessment is on the Australian economy, and where you think the economy is going now, and what you expect to see in 2020.
So thank you for the question, Darryl. So so a few points to make. The first thing I'd say is it's very convenient for that bank economist, like the federal government, and I'd put the Prime Minister and the Treasurer in the same category, to blame overseas. So there is a whole host of factors that point to a slowing global economy. There are a range of problems. Some of the problems you listed. There are other sort of tensions around the world. India, Pakistan, US, Iran, that obviously have to be looked at. US manufacturing is technically, it is in recession. You look at the PMI index, it's below 50. The service sector is slowing down in the US. China's economic growth that is slowing down as well. And obviously, when you look at interest rate policy, the Americans have cut interest rates. The Europeans have gone into more negative. The Europeans have started QE. We've got problems in the interbank lending market and with the American banks, with the repo market. There's a whole host of interesting factors that have started probably since 9/11 in terms of the US. Initially, they said it was going to be, there was issues with liquidity in the banks because of the end of the quarter, tax obligations, and a few other things like that. Then they extended it to the 10th of October. And then when we go closer to the 10th of October, they said, no, we're going to extend it to November. Now they're saying that these repo operations are going to go into 2020. And it looks like there is something fundamentally wrong with the American banking system. And there's a lot of speculation as to what it is. So it's obviously not the initial set of excuses that the New York Federal Reserve indicated. So it's likely to be one of the major banks having a liquidity problem. It could be an issue in terms of bad loans, an issue of some of their derivative positions that have potentially blown up their balance sheet. JP Morgan is saying that there are regulatory problems. So after the global financial crisis, the American banks had to hold more capital on their balance sheet. And JP Morgan is saying that's the issue about why JP Morgan can't lend more money into the interbank lending market, and that's what's causing the shortage. There are, I think, some questions as to whether that explanation is correct or not. There's a whole host of problems around the world, and obviously we saw some in last few months some banks fall over. There was a bank in China that fell over about 3 months ago. In the last fortnight, there was a bank in India that basically collapsed because of fraud. 900,000 customers. It's PMC Bank in India. Basically, 900,000 customers had lost access to their deposits, etc. And the government had to step in. So you've got a slowing global economy, just like the IMF said. And obviously, going back to the initial premise of what is economic Armageddon? What am I talking about? It's Australia's got the biggest debt bubble in the history of the country. At the same time, we've got the biggest debt bubble in the history of the world, and all of this debt is now, causing. What has fueled economic growth since the GFC? It is the growth in debt, and the growth in debt is slowing down, both in Australia and around the world, and that's obviously taking an impact on in terms of global growth and domestic growth. But putting the world aside, there's a whole host of factors that point to the Australian economy. So it is weak. Again, when the Treasurer says that the fundamentals are strong, I don't believe that to be the case. The economy. It looks to be quite sick. And obviously, we've seen 3 rate cuts by the RBA since the federal election. We were at 1.5%. Now we're at 0.75%. And there's obviously speculation we're going to see further rate cuts as early as February next year, and the launch of unconventional policy. So obviously, if the economy is strong, why is this all happening? And the reality is that the debt bubble, the domestic debt bubble, is starting to fall apart. You look at credit growth going to housing; it's at a record low. And basically, what drives a debt bubble is basically trying to add more debt into the system. And the growth of debt is actually, particularly in housing, because we've got a household debt bubble. I mean, that's at a record low if you look at the RBA series. And that's obviously having an impact on, so households are effectively tapped out. Households are struggling to borrow more money. And what does that mean? It basically means that there are problems with the retail sector. People are not able to spend enough. There's obviously, a whole host of issues in terms of the real estate market. And we'll talk about, what's the real position of the real estate market later in this interview. Obviously, when you look at construction, I mean, the RBA has flagged that they're concerned about construction jobs going forward, and obviously, in terms of income growth and wages growth as well. And obviously, if you look at job vacancies has slowed down quite a bit. So obviously, unemployment is still, in a reasonably good shape, basically in the low fives. But where you have, further, where you have further weakness in terms of, in terms of construction, in terms of retail, you're going to see job losses mount in the next few months going into 2020. And all the factors point to, a slowing economy. And that's obviously why the RBA is continuing to cut rates. That's why the International Monetary Fund, they have downgraded Australian economic growth, and they have called on the Australian government to abandon the surplus and to spend more money, particularly on infrastructure projects. The Reserve Bank wants the Morrison government to go into deficit and to grow the deficit, not to have a surplus budget to spend more money. And the reality is that they're doing this is because the economy is slowing, and everyone is nervous that without enough intervention from the federal government, the private sector debt bubble could fall over.
In this presentation, John, the economist said that he did not believe that the last rate cut, a quarter of one, was warranted, and it was a poor decision. But he also felt that there were going to be 3 more rate cuts between now and June 30 next year, which would take us to 0. He said, which I think would be a mistake. What are your thoughts there?
In terms of whether the rate cut was a mistake or not, so we obviously have to remember what is the mandate of the Reserve Bank. So it's to drive full employment, it's to have, to keep inflation under control and to deliver, good outcomes for the welfare of the Australian people. So, when the RBA is saying that consumption growth, consumption is weak, and it's uncertain, and the RBA has completely misjudged the economy. Late last year they thought that consumption was going to be quite strong, and it fell off a cliff, and they didn't see it. Obviously now they're starting to see problems in the construction sector, and there was a speech last week by one of the Deputy Governor Guy Dobell, and he said they didn't anticipate that the construction sector was going to be as weak, compared to what they're seeing at the moment. So the RBA appears spooked. In terms of economic growth, it's weak. Consumption is weak. Wages and household income growth, that's all looking weak. And then you've got particular sectors around this debt bubble, whether it's finance, whether it's construction, whether it's retail, real estate, etc. They're all looking, quite shaky. Retail, you could say retail, the retail sector is in recession. The construction sector is heading towards recession, and obviously, parts of the real estate market. I had an email in the last 2 months that said that, one of the big real estate chains in the last 12 months. 12 months ago, they had about 15,000 real estate agents across the country. Now they only have 9,000. So even in the real estate market, real estate agents are losing jobs left and right because there's not enough volume on the market to be able to sell. So obviously that's why they cut, because they're concerned. And obviously, once the RBA makes a decision to either raise rates or to cut rates, it does take time for those rate cuts to flow through the economy. So by virtue of the RBA cutting the interest rate in October, like it was in September. What it means is that they're anticipating that there'll be further. Actually, no, they did cut in October. By virtue of them cutting in October, what the RBA is signaling is that they expect that there'll be further weakness going forward, and they want to sort of meet that weakness, cut it off at the pass by cutting rates early, so that as the economy becomes weak, there's more support to help the economy in late 2019 and going to 2020. So I mean, look, so obviously, I don't think that the RBA should be cutting rates personally, not because of economic growth, but because all they're doing is just kicking the can down the road. And we have a government and a Reserve Bank governor that just will not come to in front of the Australian people and actually tell them what's going on, that we've got this big debt bubble, and that we need a fundamental rethink of policy, so that we can actually come to terms with the real state of the economy.
Yeah, John, look, I do have the question on interest rates will come further in our conversation as my next question. But before I go into my next question, I'm going to go back to the state of the not only Australian economy, but the actual world economy. And I picked up an article. It came from, it was posted by Zero Hedge. And the main headline of the article was, Central Bank issues stunning warning, quote, if the entire system collapses, gold will be needed to start over. And I kept on reading the article, and there was two quotes that came from this which I would like you to comment on, because these are incredible coming from a central bank. So now we got to look at the Dutch National Central Bank. Quote number one, a bar of gold retains its value even in times of crisis. This makes it the opposite of shares, bonds, and other securities. End of quote. Next one. Gold is the trust anchor for the financial system. If the whole system collapses, the gold stock provides a collateral to start over. Gold gives confidence in the power of the central bank's balance sheet. Would you like to make some comments on that from the Central Bank of Holland?
What we're hearing is some pearls of wisdom from the in terms of the Dutch. So obviously gold and silver have been that it's been money for 5,000 years. It has retained confidence and trust. Going through a whole host of different societies around the world, and the reality is that we have a big debt bubble, we have a big bond bubble, a big stock market bubble, a big real estate bubble. And those bubbles are becoming more problematic, particularly when you look at the global bond market. Look at the recent statistics suggest that at least 15 trillion of global debt, they have a negative yield. So this is the first time in world history that you've got negative yielding debt. You invest to make money. You don't invest to lose money, and the proposition is that if you buy a bond with a negative interest rate, you're going to get less principal. But when it comes to maturity, and that makes no commercial sense, and so that's obviously problematic. And when you've got $15 trillion of this stuff, it doesn't point to a healthy financial system. And obviously, in the last couple of months, you've had the UK, or in terms of the Bank of England, in terms of the Governor Mark Carney, he basically says there's a problem with the global financial system. We need to move away from the US dollar. We need some sort of replacement. And there's been, going back to Jim Rickards. Jim Rickards has been saying this for a decade. And there's obviously speculation as to what could replace the US dollar. But it was a quite shocking statement that the governor of the Bank of England would go on the record and actually say this. And he actually said this while he was at Jackson Hole in the United States, saying to the Americans, your dollar's pretty much questionable among the world powers, and we want something different. So obviously people are losing confidence in the system, in the US dollar, and people want a replacement. And obviously gold and silver will have to play a role in that, because there's universal trust. whether it's the Americans, the Europeans, the South Americans, the Russia, China, Iran. They all trust it. But some people don't trust each other's currency and each other's paper. So it makes perfect sense for the Dutch to say that if there is a meltdown of the global markets and in terms of the international monetary system, and you need to start over, that gold and silver has to, particularly gold in this case, that gold has to, be the cornerstone of any rebuild of the financial system.
Well, it sounds like the Dutch, I know the Chinese and the Russians have been hoarding or buying gold. I wouldn't say hoarding it, buying gold, but it's obviously the Dutch are starting to, are the first country in the Western world that have started to recognise that maybe a bit more gold might be the answer. Getting back to interest rates.
Mind you, they have been there before, Brian. The Dutch have been there before.
Ah, yes.
For 100 years. And they knew the value of gold then, but they messed it up like every other government, every other country since has held that position.
Yeah, that's exactly right. They have a bad memory for what worked in the past.
Correct, yeah.
Getting back to interest rates, John, the RBA has cut official interest rates since the 2019 election, from 1.5% to 0.75% with 3 rate cuts. There is speculation of more rate cuts in 2020, as well as potential introduction of unconventional monetary policy, I wonder what that may be, such as quantitative easing or negative interest rates. Before I ask you to make a comment, I don't understand the whole philosophy of how countries around the world are looking at this, because we already know that many European countries have already gone into negative interest rates, and I don't see any growth coming from those countries. The only one that supposedly has growth is the United States, and they're cutting as well. But they haven't got into negative yet. But with all the negative rates that are out there and no growth, how can the Australian government cut rates to 0 and expect to have growth? What's going on?
So the reality is that we have a global debt bubble that is causing huge problems around the world, you've got world central banks trying to keep the show alive. I think a few months ago both of you interviewed Darryl Salente, and Darryl Salente said that we would see the biggest depression in world history. Now, there's a very good statistical reason for why Darryl Salente said that. Is that because we've got the biggest debt bubble in the history of the world, and if that debt bubble collapses, we would have the biggest depression purely because we've got the biggest debt bubble that we've ever seen. So, and if that were to happen, that would be a catastrophe on a huge scale. And Darryl Salente talked about his getaway plan and how to survive that, and he was
quite drastic.
Indeed, but the reality is that if a world depression were to occur, according to what Salente was saying, you would need drastic action to be able to, you need drastic action in order to survive it, but also in terms of to thrive. So the reality is that politicians and world central banks don't want to face the reality of a global recession or a depression, and they need to keep the debt bubble alive. And the problem that they have is that they've cut interest rates all the way down to 0. Who was the one that was advocating for in terms of 0 interest rates all those years ago? It was John Maynard Keynes in 1936 with his book in terms of the general theory, and that's something that I learned when I went to university. And a lot of his ideas, have found out to be quite bogus when it comes to macroeconomics. So we're on this big monetary experiment, by the great Messiah Keynes. We're following his prescriptions, and we've got to the stage of, we are in one of the most precarious times in economic history. We're in one of the worst precarious, economies in terms of world history. And central banks don't know what to do. And so obviously since the GFC, they've tried a whole host of monetary experiments in terms of quantitative easing, in terms of negative interest rates. And the reality is that, what they've been doing for the last 10 years has been a big experiment. They didn't know exactly how it would turn out. A whole host of plans were made. like Ben Bernanke when he said that if we start QE, we can reverse it within 15 minutes. And the reality is that you look at what the Americans have done. They expanded the balance sheet from 800 billion to 4.5 trillion. Then they said we're going to do quantitative tightening, and that took it from 4.5 trillion to 3.8 trillion. And what we've seen with these, what's happening in the repo markets and the interbank lending market in America is they've had to start QE again. Darryl referred to QE4, so it is QE4, and the balance sheet is quickly expanding. And what is QE? It is when the central bank prints money to buy either government bonds or corporate bonds because there's a lack of private sector demand to buy the bonds at a particular interest rate. So the fact that they bought 4 trillion of this stuff, they can't sell it because there's no one in the private market to actually buy it. They don't have the cash to be able to buy it. So they're stuck. So, and obviously when it comes to Australia, this is why I'm completely against QE, because once you start it, you can never reverse it because you will not get enough private sector demand to buy the bonds that the central bank and the government that they've bought with all this printed money. And so once you start it, you have to keep going. And in terms of negative interest rates, again, in world history, we've never seen negative interest rates. And when you look at what, particularly is happening with some of these European banks are struggling to make money because of the generally they lend money at a cheap interest rate and then lend it at a more expensive interest rate in order to make a profit, and the profitability of a number of these European banks, including Deutsche Bank, is all coming into question because of what's happening in terms of these negative interest rates being imposed by the European Central Bank. So again, once you start QE, you can never reverse it, and it's just going to keep going until you ruin the currency. And then in terms of negative interest rates, the whole theory is to get the money out of the bank, get deposits out of the bank, and get them deployed into the economy through either investment or consumption to boost short-term economic growth. But that's having unintended consequences with the profitability of the banking system. And all it takes, is one of these big banks, whether it's Deutsche Bank, JP Morgan, or some of the banks in the UK, if one of these big fish was to fall down, that's enough to cause a new global financial crisis. And I think I've said this in a previous interview, and I'll say it again. Earlier this year, I listened to an American expert who talked about Deutsche Bank and said if Deutsche Bank goes, it's Lehman Brothers times 1,000. And Lehman Brothers nearly collapsed the world. And think of Hiroshima times 1,000. That's what we're talking about once we get to, because again, Deutsche Bank has a derivatives book of 40 trillion. JP Morgan has more than 40 trillion worth of derivatives. And if one of these big fish go, the financial system is stuffed, and it is a global meltdown, truly.
Mm-hmm. Wow. That is quite an answer, John, and thank you very much. And I think we're in uncharted waters. So, Darryl?
I'd like to have a quick chat with you about property, a question on property prices. John, has property recovered or has it not recovered? The big debate. Mainstream media are reporting that it's happy times once again for Australian property, as they claim there's been a very robust recovery in Sydney and Melbourne property prices over the last few months. Now, you just recently explained there is new evidence suggesting that there has been no recovery in Sydney and Melbourne property prices. Can you explain this, John?
So what we would have is, we would have some of our viewers, here. They follow me with Martin North on our YouTube channel, In the Interest of the People. So we released a show last week, which went for about an hour, that we dived into this subject. And what we explained is that where is this narrative around a robust recovery in Sydney, Melbourne house prices coming? It's coming from one data set that everyone uses, including the government, and that basically is CoreLogic. So CoreLogic basically has so CoreLogic has a hedonic index, which basically gives you daily and quarterly price movements in property, and we don't know how they've actually calculated those particular numbers, but the definitive source on property prices is the official record kept by the government, that's collected by the Valuer General. Now, it takes about 3 months after a property is settled for the Valuer General to get that data and for organisations like CoreLogic, to obtain that data to have the definitive record. So now, for the last quarter, so the first 3 months of the financial year, CoreLogic said that Sydney property prices went up about 3.8%, and Melbourne property prices went up 3.6%. Now, for them to make that claim with a quarterly hedonic index, which was actually, and these indexes were created, the methodology was created by my nemesis, Christopher Joy, who I debated earlier this year on the Your Money program with Peter Switzer. They haven't used the official data from the Valuer General. They're using other forms of data. So because they have been long trusted in the market, everyone from the government and the ABS uses them as their benchmark for the official ABS statistics. The Reserve Bank uses CoreLogic, the media uses CoreLogic, the banks, consulting houses like Deloitte Access Economics, they all use CoreLogic. And so everyone has been led to believe that there is a recovery based on this one organization's data. And including myself, about a month ago, I accepted the premise that Sydney and Melbourne house prices were going up, and I thought it was a short-term blip. But what happened was in the last couple of weeks was a rival group to CoreLogic, REA Group, and they own realestate.com.au. Basically, their chief economist, Nerida Consby, gave 2 interviews, one with Martin North and one with Peter Switzer, and basically said that they don't see evidence that there is a robust recovery in Sydney and Melbourne property prices. She said that in certain premium suburbs in Sydney and Melbourne, it could be like Vaucluse or, say, Toorak in terms of Melbourne. You are seeing some strong action in terms of those premium suburbs where the wealthy have some cash or the ability to borrow. They're bidding up property in those particular suburbs, and that's happening on low volume, by the way. But when it comes to the broader market of Sydney and Melbourne, when you look at houses as well as units, there is no evidence, according to REA Group, that there is any recovery in terms of property prices on the scale that CoreLogic has been saying. And so that really sort of shocked me, because I've been accepting what everyone has been saying, and then I thought to myself, is it possible that the country has been led to believe a hoax that never existed? And so that's where I asked Martin North to crunch some numbers with his own data set. And we presented those numbers on the show, on our show last week. And basically, what we walked away with is saying that Sydney and the Brisbane markets in the first quarter actually have fallen when you look at units and houses. So the broader market has actually fallen; it hasn't risen. So basically, DFA is saying that Sydney property prices fell by 0.43% as opposed to increasing by 3.8%. And then in terms of Melbourne, Martin's data is saying that the property prices just went up by 0.09% as opposed to 3.6%. So we, and it's interesting because it's only been out for 4 days. The show's already had about nearly 40,000 views. I sent it to a whole bunch of people in the industry, people in the media as well. So it'll be interesting to see what the response is. But there is a possibility. Because CoreLogic hasn't actually explained exactly, at a very technical level, how did they come up with these particular numbers of a recovery. And so everyone has just accepted that their numbers are accurate. And now there's a controversy because other people in the market are saying, well, we don't see these numbers happening across, because particularly when you look at units, high-rise units in Sydney, Melbourne, the demand for those have just collapsed because the quality issues in the construction sector has exposed. Yeah, exactly. So it's exposed how risky these investments are, and so the demand for units has collapsed. So houses are, demand for houses, it is positive in Sydney, Melbourne, and Brisbane, but the rate of growth, if you look at the entire Sydney market, it is nowhere near 3.8%. And so there's controversy about the data, and there's a real question now as to, has the country been led to believe a hoax that, and a fallacy that basically never existed? And it's now really on CoreLogic to come forward and explain why their numbers accurate, and in terms of look, and obviously how did they get to these numbers of 3.8 and 3.6% for Sydney, Melbourne, respectively, for the first quarter. And so far they haven't done that. But a month ago I accepted there was a recovery. Now there are other organisations saying there's no recovery. I think the jury is out. And when you look at the other data around the economy, when you look at in terms of the growth of in terms of credit growth, when you look at the employment market and how you're seeing some weakness there, retail, and when you look at what happens in terms of the retail sector, in terms of how people are spending, I'm coming away with the conclusion that there's basically no recovery at all. It's been either flat or falling in the first 3 months. And anyone who claims that there is a recovery, just ask them, what is your data source? And let me just give you a quick example. So last week in the media, news.com.au, for example, reported that Deloitte Access Economics, one of their partners, Chris Richardson, who's based in Canberra, he went on the record and said that he wrote an executive summary for a business outlook for September. He said that Sydney house prices are rising $3,000 a week and Melbourne house prices are rising $2,500 a week. Well, I emailed Chris and said, well, what's the source of your claim? And late last week, after I recorded the show with Martin, he replied back to me and said, CoreLogic. And that's the big problem. Everyone's using CoreLogic, everyone's accepting it. And even in the last, I read something today, ANZ is expecting that property prices in Sydney, Melbourne to rise by 12%. Between sort of July of this year and July of next year. Well, if you went to ANZ and said, what's the basis of your claim? They're all going to say CoreLogic, and there's a big question as to whether CoreLogic is accurate or not. And so, I've walked away from that experience and that recording to believe that there is no recovery, and that there is a big issue with CoreLogic's data. And we went through some of those issues with Martin last week. And so, so if people think that there is a robust recovery and they're hearing it in the news, that they really should just, obviously, and again, certain suburbs are going quite strong, but when you look at, say, Western Sydney or Southwest Sydney, it's still falling. So people need to be careful about, what they hear on the news, what the sources that journalists rely on, and obviously question the veracity of those sources before making any sort of significant purchases or investments.
$3,000 a week, John. I think that's what you said. $3,000 a week multiplied by, let's call it 50 weeks in a year.
150,000.
That's 150,000, if my math's correct. We all need a wage rise in a real hurry, John.
Of course.
Yeah. Once again, totally unsustainable, ridiculous comment.
So let me be blunt about this. The ABC has called Mr. Richardson and Deloitte Access Economics as one of the most respected economists in the country, and he made this claim on his website. I received the email and I read it, and it said $3,000 a week for Sydney, $2,500 for Melbourne. And I emailed him, so what's the source of this claim? It says CoreLogic. And now people, people independent of me, and the significance of REA Group is they realestate.com.au, it collects enormous amounts of information from the market. So 95% of real estate agents, they list with realestate.com.au, and part of the deal is that when they sell a property, they have to put in a lot of detailed data into the REA Group system, into realestate.com system, so that they can basically tell realestate.com.au what happened with the property, how much did it sell for, etc. So REA Group has enormous amounts of rich information directly from the market, and they've come out on the record and said there's no recovery, and I'll go with them.
Yeah, look, once again, in direct contrast to the $3,000 a week increase in valuation, I was speaking with the CEO of a major construction company in Sydney the other day. Amazing the people you talk to in this industry. But he said, Darryl, I have lots of friends in the same industry. We have thousands of apartments that are in the process of being built. Lots of people put lots of deposits down on those properties. They've since gone back to the bank now that it's getting much closer to the purchase, and the banks are saying, hey, the value of your property has dropped. You'll need to come up with more. More equity. So you're going to have to. You need more money, and you need a bigger deposit. And a lot of these people are just walking away from their agreement because they just can't fund it. So that would be in direct contrast to the information that you've just provided us. and I tend to believe my friend, who I have direct contact with and comes across as and I know him as a remarkably astute man. So amazing the contrast and the variation in reports that we're getting, isn't it?
Absolutely.
Brian.
Yeah, just before I go on to that next question, I'm amazed this 3,000 extra per week. And when you think about it, what sort of salary would a high income earner would have to be on to find an extra $3,000 a week? Because at some stage, that $3,000 a week has got to be paid back. So he's got to be on some sort of phenomenal income to actually open up his wallet and find another $3,000 a week, because that's what the price of the property is. It doesn't make much sense to me. Anyway, my next question is really in reference to cash transaction ban legislation. John, I know that you and others have caused significant controversy, to say the least, in opposition to the Morrison government's proposed legislation to ban cash transaction above $10,000. Many of my clients are from Good as Gold have expressed significant concern about this legislation and what it would mean for their economic freedom, especially in an environment of an economic crisis or even negative interest rates. Can you give our audience an update on where this issue is up to? And please don't leave out the section which I think you told me last time, is that it's not just a one-off transaction of 10,000, it's a multiple transactions which add up to 10,000. Could you explain?
Correct. Yeah. No. Look. Yeah. So Brian, on that point, you are 100% correct. So the government has introduced legislation into Parliament, making it illegal to conduct a cash transaction above $10,000. So that means the transaction is either for a particular good or service, whether it's one payment or multiple payments adding up to 10,000. I mean, that's what they want to make illegal. So obviously, the Morrison government announced this in 2018 in the federal budget when Morrison was treasurer and Turnbull was still prime minister. Basically they went quiet on this, and then in early August the treasurer went public with a consultation process on the draft legislation, and that's where Martin North and we did a show exposing what's really going on. And that show got 90,000 views on YouTube, plus 91,000. And so we've galvanized people across the countryside, and politicians have been bombarded with emails, and the consultation process received thousands of submissions into Treasury saying that we don't want this cash ban. So the government has made claims about what is this ban all about. It's about improving the integrity of the tax system. It's to stop tax evasion. Claims of tradies doing deals in cash so they don't have to pay tax. There's obviously claims around in terms of gangs, crime, drugs, illicit activities. A lot of these deals are being made in cash, the government claims, and therefore we need to impose a cash transaction ban in order to clamp down on the so-called black economy.
So, John, what is the real reason why they're doing this negative interest rates and cashless society situation?
So the government claims that the legislation is to improve the integrity in terms of the tax system. It is to clamp down on the black economy. It's to clamp down on so-called illicit activities around drugs and crime, that they claim a lot of these transactions are being done in cash. But my position is that the real reason that they're pushing this is because of negative interest rates. And there's a whole host of world central bank technical papers, including at the IMF, have basically said that physical cash poses a problem in terms of negative interest rates, because when you hold a physical $50 note, what's the interest rate you pay on that note? It's basically zero. So you receive no interest, you pay no interest. Whereas if you've got money in the bank and the interest rate is negative, well, then basically you have to pay the bank money. And obviously the natural reaction is to take your money out of the banking system and to hold physical cash. And so we have, it's not just in this country, we have a global war on cash. So some of these cash transaction bans are actually operating in Europe, particularly in, say, Spain, France, and Italy. I think in France, You can't do cash transactions above €1,000. I think in Spain it's €2,500, and in Italy it's about €3,000. So these techniques are being implemented in Europe already. Obviously, the Australian government, and they had a black economy task force, and this is where the recommendation came from. That they're basically arguing that they need this to clamp down on the black economy, but it's all about setting up what the world central banks want to do. And obviously, the IMF has said that if we have a recession, interest rates have to be cut anywhere between 3 to 6% in order to stabilise the economy. Obviously, when we look at Australia, we're already at 0.75. Well, if we had to cut between 3 to 6%, we're not just going into mild negative, which could be negative 0.5% to negative 0.75% like Switzerland. We'd have to go to -4, -5%, which we've never done before. And obviously, if we went to that level of negative interest rate, it would absolutely smash the profitability of the commercial banks. And if you look at some of the Danish banks, I mean, there was one Danish bank in particular that started imposing a charge on deposits above $1 million. In terms of $1 million US. Then they changed their mind and said, no, we're going to lower it to 100,000. And then they said, well, we're going to keep it at 100,000, but we may change our mind, and we may actually impose a negative charge on all of our customers. And we're already started to see this already being imposed in Germany as well. So the reality is that, so just for people to understand what is negative interest rate. So the negative interest rate is imposed by the central bank on the commercial banks. And the commercial banks have to make up the money that they lose by having to pay the central bank money on their reserves. And the commercial banks have a number of ways that they can make up the money. And obviously, when you look at the Danish and the German banks, I mean, look at all of the techniques that they could have used that do not require them to charge customers. They've been exhausted, and now they're starting to impose negative interest rates directly on customers. And obviously, they start with the rich customers, people with high 6 figures or high 7-figure balances, and now that's not enough money to make up for the negative interest rate. And obviously, they're starting to lower the bar and charging negative interest rates on sort of middle class customers. And so that's obviously part of the risk for. Whether the broader Australian people or our clients that are as good as gold who have money in the bank, negative interest rates could result in you losing money directly. And obviously, if you want to withdraw your money, so under this legislation, you can withdraw your money in terms of physical cash. But what can you do with it? Well, I mean, you can't do much with it because if this legislation goes through Parliament, I mean, you can only transact up to $9,999. And so, I've heard excuses from federal parliamentarians saying if you want to do a $10,000 plus transaction, if you've got cash, just put it back in the bank and then do the transaction. Well, and again, I mean, look, there could be a whole host of problems with the banking system, whether it's negative interest rates or other things that people don't want to deal with, and yet. The choice of having, the freedom of avoiding the banks is being denied under this legislation, and that's why I've been extremely aggressive in terms of trying to stop it. So where are we up to with the legislation? So basically, all the pressure we put on the parliamentarians has forced a Senate inquiry to be that was set up last month. Submissions are now being called by the committee. Which is due by the 15th of November. Hopefully after that, there'll be some hearings and the inquiry will basically provide us a report to the Senate in about February of 2020, and then we'll obviously see what that report says. So, I mean, today is Monday, and then obviously, in terms of this week, we have Senate estimates happening. So I've been working with some parliamentarians to ask some questions. We have Treasury and the Australian Tax Office coming up on Wednesday. We've put some questions forward that we want some senators to ask those agencies about this this potential legislation. So we'll wait and see what answers we get out of that. And obviously, I'll be putting my submission in before the 15th of November. And obviously, a lot of Australians need to continue being focused on what the government is doing, because I mean, the reality is that what have we been talking about right throughout this interview? The economy is slowing, politicians and central banks are starting to panic. And they're taking more and more drastic actions, whether it is zero interest rates, quantitative easing, or even going into negative interest rates. And so the more extreme the economic circumstances become, the more extreme the governments will become. And obviously, we're starting to see this with this cash transaction ban. And obviously, citizens will lose more rights and more wealth throughout the process. And there has to be, citizens have to be vigilant in terms of the economic situation. They have to be vigilant against what the government may do, but they also have to be vigilant about protecting their wealth. And obviously, this is why I've been buying precious metals for a number of years, because I'm trying to be vigilant against what the government is doing in terms of printing all of this all of this money, debasing the Australian dollar, losing purchasing power. But also, you're looking at all the other investment classes, whether it is bond stocks or real estate, and they're all in big bubbles. Well, if you're going to be vigilant about wealth protection, gold and silver, it has to be part of the mix. And for me personally and my family, that's why I've been buying for quite a few years, and that's why I reached out to you guys last year and said, I want to be part of the team. And obviously, we've been together for coming nearly on about 15, 16 months. In terms of me being a chief economist, but yeah, I mean, look, we're getting to crunch time about why gold and silver is really important, because it's when people lose confidence in the system, governments start to panic, governments start to become extreme. Well, what can keep your wealth intact? Gold and silver. That is the ultimate answer, and it's been the ultimate answer for 5,000 years.
Yeah. The whole conversation reminds me of a statement that J.P. Morgan made when he said, I only buy when there's blood on the streets. And when you actually think about the riots in Europe, you have a look at Europe is where the most negative interest rates are. And they've got Spain, France, Italy, yellow jackets and all this sort of thing. All these riots going on. You just have a look at the history. This is where the negative interest rates is going. So unfortunately, the blood on the streets thing seems to be panning out.
In conclusion, I guess, John, I'd just like to add another point here, just before we close off today. And I know that this has been a rather lengthy discussion, but I was reading the other day that the Cass Freight Shipment Index, which is a measure of global freight, in particular North American freight, their volumes are down 10 months in a row. Now, this is quite extraordinary. So this has led Cass Freight to say that they see a growing risk, believe it or not, that GDP will go negative by the year's end. They are now forecasting a major economic downturn. What they've noticed is that most of the sales and the export, and it's in all areas, it's in air, sea and road freight, all down, but it's mainly revolving around auto and building materials. I mean, you've got to be kidding if this isn't a real strong indication of where the economy is heading. So, no question, these numbers are just brand new from last month, 10 months in a row down. So, you made a point just a moment ago, John, you're absolutely correct. I mean, precious metals, I don't know where else you would go in this sort of environment. History tells us 5,000 years. 5,000 years, gold and silver have stood up. And, I guess what I'd like to say here is I refer back to Chris Joy's comments with you. Chris Joy said, if there's a major global economic downturn, all bets are off. I remember him saying that clearly. Do you remember him saying that, John? Okay.
100%.
Now, we are in, according to all the reports that we're getting at the moment, we have a major global downturn on our doorstep. In which case, and for 5,000 years, the the best thing you can do is to hold precious metals. Hold an asset that retains value under those unique set of circumstances. 100 years ago, gold was $20.67 an ounce. Today it's spot, US. Today it's $1,500. In 1935, an ounce of gold was $35. And today, well, let's go back to 1935, $35. An ounce of gold and $35 bought a really good suit. Today, an ounce of gold would still buy a remarkably good suit. The $35 would fall well short, of course. Precious metals hold their value in all environments, and in particular, the one that we are entering into now. So I guess I get back to what Peter Daniels told me many, many years ago, my lifetime mentor. Darryl, save in precious metals. Save in an asset that holds value. Jim Rickard's, 10%. Just put aside 10%, because if all else fails, if all of the other markets collapse, the 10% that you've got in precious metals will hold you in good stead. Jim Sinclair. I mean, these guys are very, very smart. And Jim Sinclair, multi-billionaire. Jim said, become your own central bank. Just do what the central banks do. They're smart. They hold gold. Why do they hold gold? They hold gold because it gives them power and it gives them influence. And it gets them through the tough times. I believe that that's what we need to do. Brian and I have been saving in precious metals now for 26 years.
Absolutely.
So anything that we could save, we just put the money aside. And people say, well, I want it to happen tomorrow. We've got to be patient. But we won't have to be patient for a lot longer. This is all, as John has mentioned, and we've said, we're about to fall off a cliff. This is you really need to seriously consider, I believe, doing something now. As a matter of interest, John, next Tuesday night, we have an interview with Jim Sinclair's partner, Bill Holter. We're really looking forward to this. Bill is a big Texan. He'll be bright and sharp when he's speaking with us in this interview. I'm not sure about you and I, Brian, because this is going to be 1:30 in the morning, mate. I cannot believe this. So we're going to be tested to the fullest. If we look a little sleepy and dreary-eyed, you'll understand why. But, John, hey, I endorse everything you've said. Once again, your comments are always valid. They make so much sense, as you always have. We really appreciate the time and effort that you put in at As Good as Gold Australia, John. You're a remarkable asset. And I'd also like to thank, as always is the case, our viewers and our subscribers, because you constantly provide support, which is we really appreciate. So until next time, hey, stay well, stay focused, and goodbye for now.
Goodbye for now.